current tax. This refers to the actual amount of tax which now a company is supposed now to pay to the government in respect now to the trading activities of a certain reporting period. So mean that this is the actual amount of tax, payable to the tax authority, in respect to the trading activities, activities of a certain accounting period, So therefore, current tax will refer to that amount of tax which now a company is supposed to pay. And also what we need to remember from taxation is that this particular amount of tax which the company is supposed to pay should always be based on what refer as the taxable profit. And also from taxation, you must be in a position to remember how we compute the taxable profit. So therefore, the current tax, therefore, we say is the actual amount of tax which is supposed to be paid. Now, in this particular case, we also need to look on how this particular tax is supposed now to be recognized by a company. That is recognition of current tax. Now, this tax which now a company is supposed now to pay in a certain accounting period, according to IAS 12, it should be accounted for as an expense. So mean that the amount of current tax, this will be accounted for as an expense, in the income statement, statement. And that's why whenever we are to prepare the income statement, what we do is that once now we get the profit before tax, we are supposed to proceed and we less the current tax. So the reason why we less that current tax, it is because that tax is an expense, in the income statement. Also, according to IAS 12, if at all maybe we have any unpaid tax, or what we refer as a accrued tax, this is basically the tax now which the company has not paid, maybe at the end of a certain accounting period. Now, this particular tax which has not been paid, according to IAS 12, it should be accounted for by the reporting entity as a current liability, Now, on the other hand, there are some cases whereby a company may have paid more tax than it was supposed to pay, meaning that in such a case, then we may be having what we refer to as a prepaid tax. Now, such a prepaid tax, then this should be accounted for by the reporting entity as a current asset, because by the end of the day, the company can be able to recover that particular tax from from the government. But on the other hand, what you need to remember is that whenever now we are to determine the actual amount of tax which is supposed to be paid by a company, we have said that that tax, or basically now the current tax, which you have said is the actual amount of tax, this is always computed, or it is determined based on the taxable profit. Now, in this case, when we talk about what we refer as the taxable profit, this we say is that particular profit which is computed by the company based on what we refer as the existing tax laws, meaning that for us to be able to compute the taxable profit, we take the taxable incomes and then we less only the allowable expenses. So therefore, the amount of tax which is supposed now to be paid, it is determined, or it is computed based on the taxable profit. And therefore, what you need to note is that as at the end of the year, the amount of tax which will be charged in the income statement is usually a provision. Is usually what? A provision, meaning that the amount of current tax which is charged in the income statement at the end of the year, at the year end is usually a provision. Now, in this case, the reason why we say that that particular amount is a provision, it is because the amount of tax which is supposed to be paid, it will always be based on taxable profit. Now, what we know from taxation is that for a company to be able to compute the taxable profit, that profit is always computed from the accounting profit. Now, in this case, there is a difference between taxable profit and basically accounting profit. Before we go back to this, so when talk about what we refer as accounting profit, we say that this is a profit now which is computed by the company based on the accounting concept and also the accounting policies applied by by an entity. And therefore, once an entity prepares the income statement at the end of the year, that profit which is reported there, or what in other terms we refer to the profit before tax, that is the accounting profit. It is the accounting profit, and the tax, or the actual amount of tax which is supposed to be paid, is never determined on this. Rather, it is determined based on taxable profit. And therefore, what we are saying is that once now the income statement has been prepared at the end of the year, then the profit which will be computed will be the accounting profit. And therefore, that particular amount of tax now which we provide for in the income statement, it will actually be be a provision, because now the taxable profit can only be determined after the preparation of the income statement. So therefore, that is very, very important, that this particular amount of current tax which we charge in the income statement, it is not the actual amount of tax which will be paid, but rather it is a provision. And therefore, once now that a provision has been provided for, or the amount of current tax has been provided for, then that will give rise to something known as over provision, or other provision, provision of current tax, tax. So in our case here, we need to know how this over provision and also other provision arises. So therefore, we do have those as basically the various formulas which you use in terms of computing now the free cash flow to equity